Welcome. Feeling good today, you guys. I hope you guys are feeling good. You know what I feel right now, Chris? I feel like a track star. You know? All right. Yes. So welcome, everybody. Tommy, can you hear me? Nobody's posted anything up there. If you look at the chat, go into the chat up top and just type in there where you're from. And that way I know that you can hear me. I don't think they can hear me, Chris, or there's nobody there.
Maybe there's nobody there.
Maybe they have their speakers turned on like yours were before.
Quite possible. It's easy to do.
It's crickets.
Here we go. Oh, now it's coming in. Good morning, Carol. Remember, Dave, do you remember that from the kids? And I see Carol, and I see Jeffrey.
Yeah.
Here we go. All right. We got the Bronx. The Bronx is in the house. Ewing. Cool. I can't believe that Barry was not the first person from Parsippany this time. All right. Okay, great. So people can hear me. Looking at the time, as everybody already went into the chat and typed in their where they're from in there. You see the chat right next to that. You will see Q&A. That's where you should post your questions during the presentation. Please don't post in the chat because we don't monitor the chat as much. That's where people like to have basic conversations and it gets a little bit distracting. So if you can post all your questions to the Q&A, that would be great. I want to welcome everybody to the sweater series. Many of you will be on here for Q&A, for CPE. If you do need CPE, there will be 4 polling questions. You have to answer at least 75% of those polling questions. I cannot tell you when the polling questions will be coming up, but just please, I will give you about a minute to answer those questions. So listen for me to say a polling question is up. So housekeeping out of the way. You know what? Before we go to the housekeeping, let's just put up the first poll, make sure everybody can see it. I'm going to do start polling. Will you use cash flow forecasting as a tool after seeing this webinar? That's the problem with some of our polling sometimes. Chris, although you came up with them in a great order, they put them in out of order. So now we want to see what they say. Hopefully the last one says, now what do you think your answer is going to be? So we'll leave that up for a minute. And we're at 80% looking at doesn't give the numbers. 85%, 86% say give it a shot. 3% say no, but I have the right. But if I had the right tools and better information, I appreciate the honest people that say just here to get CPE and see what sweater is going to wear. I've got to go with the light one. It's the summer, okay? Although it is cool out, so let's close the poll.
No such thing as a light sweater in the summer.
You don't know my sweaters, okay? My cashmere one got burned. Anyway, so today's topic, let's get into it. We gave enough people a chance to get in here. Today's topic is managing cash flow. We have 2 speakers. New one to our series is Dave Capodanno. Dave has been in practice for over 30 years, consulting his clients on many different management matters. He was very involved with ACG. I think people are familiar with seeing Chris Martin. No, he's not here to talk about PPP today. Maybe he may slip that in somewhere. But Chris has also been in practice for 20 years, and he is a CGMA, which is a fairly new designation that the AICPA came out with. And I believe, Chris, you're coming up with the CGMA series, like a video series on this possibly?
Yeah, we're working on something with that.
So long as it doesn't conflict with Sobel Insights, then we'll all be good. Okay, don't take my my viewers away. So let's jump into this. Dave, what are you going to tell us today about managing cash flow?
Well, today we're going to talk about really taking a look at the understanding the cash flow, how to come up with a dashboard. We're going to look at talk about some KPIs, talk about what your company does to manage KPIs and how do you manage your cash. Look at some techniques to further collect cash quicker, manage your payables. Talking to your bankers about lending opportunities, asset-based lending as well. So those are some of the topics we'll be talking about.
Great. So who's going to start us off, Chris?
Yep. All right. So if you want to flip to the next slide there.
Yep.
So we wanted to start the presentation really kind of with some building blocks. You talk about cash flow forecasting and management and that sort of thing, but what does that actually mean? How do you come up with a cash flow forecast? And I think really understanding just some basics as far as what a cash flow statement is, how to come up with a cash flow statement. It's really our starting point. So we're going to talk a little bit about that first, as well as some of the assumptions and things that go into actual forecasting. Starting here with this slide, really the cash flow statement, most people know this from their financial statement packages that, maybe their auditors put together. It goes to regulatory bodies, goes to banks, that sort of thing. And the cash flow statement is just kind of another page. You kind of get through the balance sheet, the P&L, and people are usually glazed over and confused at that point, and they kind of just skip over the cash flow statement because it's not really logical in a lot of people's minds and how it actually works. So, but I feel it's a really important statement. It's something that people need to spend more time on. It really does, show the operating effectiveness of a company, how they're using their cash, how they're spending their cash. So, starting with that is really where we're.
Hey, Chris, it's interesting that you said that because I've heard it. I've heard both comments, and what you said, I agree that a lot of people say I don't understand it, and I don't know. Right, most people use the indirect method. I don't think you're going to get into it. This is not a FAS 95 seminar. I don't know if we use the direct method more, if people would appreciate it more, but it's either people love it or hate it, from what I see. If people are like, I don't care about the other stuff. Okay, I look for my cash on my balance sheet, and I go to look at my statement of cash flows because that tells me pertinent information. So
I mean, I think even for us as accountants, it's coming into the profession, it's difficult to understand, and once it clicks, it kind of just really helps people better understand the business. So,
right.
All right, so we can go to the next slide. So we're going to start here with just kind of how to model a cash flow. And really it starts with, the other statements, your profit and loss and your balance sheet. So if you understand those two statements, the cash flow, just kind of becomes mechanical. It's that old mentality, garbage in, garbage out. If you've got your cash accounts reconciled, things properly classified, you really have to have a good baseline, good historic data to start with to even start considering your forecasting. Really have to make sure your accounting house is in order before you even get into any type of forecasting scenarios. The one thing that people often look at is your profit and loss statement. That really dictates, or people think that dictates where your business stands. But I think cash flow even more so does better demonstrate that, because it takes things into and out of the equation that really shows where a business stands. As many know, there's three really main areas of a cash flow statement: your operating cash flows, your investing, and then your financing. The operating are the things that are driving the business, your receivables, your payables, those sorts of things. And then you get into your investing and financing areas, which is your debt, your pay downs of debt, if you're investing in property and equipment, trying to grow the business that way, and those sort of things. And then once you have an accurate picture of those, you can move into actually creating a cash flow. You can click forward. So going back to the profit and loss, I just wanted to throw up a quick example here of just some assumptions scenario to show a basic profit and loss statement, because this will kind of build into some of the other stuff we're talking about. The one thing I just wanted to kind of point out is the documentation. Whenever you're doing any type of forecasting, we're jumping ahead a little bit, but when you're doing any type of forecasting, you really want to document the assumptions that you're using. You go back to these things and you're trying to figure out how you dropped in numbers and what these things all mean. Having a good trail of documentation is really important, especially if you're doing this manually in Excel, as probably a lot of us do. I think we'll talk a little bit later about different software and things that can help with these and make them run a little bit more efficiently and quicker. But I just wanted to kind of show just an example here of the assumptions and what goes into the profit and loss statement, which will build out our cash flow.
And it's interesting, Chris, because I'm looking at your presentation here, and my comment is going to be between financial statements that are audited, reviewed, or compiled, or management financial statements. And people should identify that there are two different sets of financial statements. Same information, don't have two different books. Don't get me wrong here. I don't want people to CPE going back and say, Brad said two different sets of books. No, the presentation of financial statements. I'm always an advocate for anything that we're auditing, reviewing, compiling. I like what you have there. It's more of an SEC mindset. It's summarized. You're giving the basic information for the reader to be able to make their decisions. That's not management. Management's set of financial statements should never look like what you have on the screen there. Right? And you couldn't put a management financial statement in this presentation. It would just be too big. But management needs to be making decisions based on a lot more information than what should be part of your financial statements that are provided to the banker. Your office supply company that requires a copy of financial statements, you don't want them to see the details. This is what you want them to see. So,
yeah, and then on top of the profit and loss statement, we didn't present it here, but the balance sheet is huge in cash flow management because it has all the other aspects, that you need to understand as far as what you're not collecting in cash, what are your payables, what type of property and equipment did you purchase during the period, and those are the items that you really have to have a good hang on to put together an accurate cash flow statement. There are other factors that go into this. You can't just take your net income and start there for your cash flow statement without understanding seasonality of your business. How long does it take to collect on receivables? How long does it take you to pay on payables? If you're in a business that sells Christmas trees, your cash flow is going to look a lot different in December than it does in August. So, and then we'll get into how often you should be doing these cash flow forecasts. But just some things to consider, with the profit and loss.
But you're not advocating spreading Christmas throughout the year.
Why not?
Yeah.
Everybody's
6
favorite
months.
holiday. Cash flow statement components. So now we'll get a little bit more into the details here, and I don't want to spend a lot of time here because I think a lot of most of you probably have seen the cash flow, but starting with the net income number that we just showed on the previous slide, that's your starting point of your cash flow statement. To that, you want to add back your non-cash activities, so things that have an effect on your profit and loss statement, but there's no cash going in and out. So depreciation and amortization is one, bad debt is another. And then, as far as operations, that's really the next big section. Thinking about receivables, payables, accruals, those types of things. What changed during the period, and how did that affect your cash? If you've got receivables in a prior period that were, recorded as sales, and now you're collecting on those receivables, that's going to be an increase to cash. Obviously, if you had sales during the current period, but didn't collect, you're not in a cash business, that those cash receipts are going to be deferred into the next period.
Mm-hmm. Yeah, I think you're going to talk about it a little bit more later on, Chris, and I'll say it right now. We use a spreadsheet to do statement of cash flows. In QuickBooks, I think you can prepare one right off the system. We use a spreadsheet. If anybody needs a copy of a spreadsheet, we'd be happy to provide it. The biggest confusion that people start off with, and it just sets them off the rails from the beginning, and they don't even really get out of the station with it, is the change in assets has an opposite effect on the statement of cash flow.
Right.
And we're not going through the mechanics today. Any of us on this presentation would be happy to discuss it with you. In fact, I love discussing it. Everybody runs when I start discussing it usually. But if you need a copy of a simple spreadsheet that we have, reach out to us and we can send it over to you. We did an in-office presentation on this. So.
Yeah, and also, Chris, just a lot of our clients, we actually do, as Brad said, we do the preparation of the cash flow statement. So it's something that if you're not doing on your own, it might be a good idea to get the model of that, so you can drop it in and look at it instead of once a year, and you can update that quickly.
Right.
As Brad said, it's the change in operations from your balance sheet, and the other items are really the gross amounts that you get.
Right.
Yep. And some of the other areas, just to touch on quickly, your financing activities, what did you do debt-wise? Did you take on more debt? And that may be driven by, cash flow forecasting decisions. You may be forecasting that you're going to have a deficiency in cash, a certain time of year because of seasonality. So you may need to forecast, taking more, drawing more on your line of credit or taking on more debt. Distributions to shareholders obviously is a big area. Sometimes that's often forgotten about when you're forecasting, just because it's something that is variable. May depend on income tax situations if you're taking distributions for taxes. owners' lifestyles, that sort of thing. And then investing activities, purchasing of property and equipment, remodeling a supermarket, those sort of things. Click ahead.
Mm-hmm.
And just real quick, just wanted to present, what that cash flow statement might look like. Again, just working through those areas we just talked about, starting with your net income, adding back or subtracting those non-cash activities, and then the operating, investing, and financing activities. And then at the bottom, they shows your beginning and ending cash position, which should reconcile to your balance sheet.
Yeah, it should is a strong, or actually it's not a strong phrase. It better reconcile. Now,
yeah.
There was a change a couple years ago where FASB came out and said, the restricted cash should be included in there too. So it may include cash, restricted cash too.
Right.
But I'm talking financial statements with footnotes and everything, not as much related to this, but just to keep that in mind.
Yep.
What I see a lot of times, Chris, especially with the younger people and probably other people that are not in industry that are not actively involved in preparing this, we have a new question came in, is what category should they be in, operating, investing, or financing? And I see people get hung up on it a lot. And I often see when somebody invests in the company, a shareholder buys more shares, they'll put it into investing. Well, somebody invested in the company. And no, that's people financing in the company. Mm-hmm. Gary or Cam, looks like goes by two names, says, can bad debt be combined with change in AR?
Bad debt on its own is a non-cash activity, right? You're writing off old AR, so it should be broken out separately. Now, do we always see it broken out separately? Not all the time. If it's nothing insignificant, sometimes it just gets pulled into the AR change. But yeah, technically it should be broken out in non-cash.
Right, I agree. That was a test. I asked him to ask you that, Chris. And you passed that. So you're at 100% for your 75% for your CPA.
There we go.
It's a poll question.
Is Chris gonna pass today? People keep coming up with questions for Chris. Let's see if he passes. He's 1 for 1.
We all say if we had to take the CPA exam again at this point, we wouldn't be able to pass it. So I don't know all these.
CPA can't pass again. Yep.
All right. So
all right, before you get into assumptions, Chris, because you're going to roll in this area, let's put up a poll. Does your business currently forecast cash flows, and if so, how often how far out do you forecast? That's a great question. I love people that want to go out cash flows for 5 years. An income statement for 5 years is bad enough. It's I don't know how realistic it's going to be. I can't imagine cash flows out more than a year. Okay, so we're looking at the highest amount is 12 months, which is what I would have expected. 3 months I thought would be short, unless you have a real cyclical and you need to know. You got the Christmas tree selling. If we don't hit this amount of sales in Christmas trees, then we're in trouble. So pretty much closing it up then, 21% says 3 months, 23% says 6 months, 43% says 12, 3% said beyond 12 months, and then 13%, I love it, says what is the forecast?
Good.
Okay. Okay.
Right.
So what about the assumptions?
Yeah, so this is an area that I really like, because it's kind of more of an art putting these things together, these forecasts. Obviously, like we just spoke about, you've got to start with the historical data, having a good baseline. And once you have that, we showed you a very small snippet of it, loss statement, no real detail. But drilling down on those areas now, what's really driving the business? Is sales the driver of the business? And most companies, that's what it is. I know we'll talk. There's a lot of people in nonprofit that are on these webinars also. Your business may be driven by grants or contributions, so you may have a completely different set of assumptions and scenarios that you have to forecast with. But we're going to talk, right now about sales, for a commercial business. Things like sales by product line, that sort of thing. Usually you look at that as a percentage of sales, by department, and then you can add things like expected growth, and using information you have historically, but also looking at other things that are going on in your business. You may need to talk to people in the sales department. Actually, don't operate in a vacuum with this, right? You want to talk to people in different areas. What is your purchasing department doing? Are they ramping up inventory for a particular season? Or, we're seeing it now in the news where it's just difficult to get product in from overseas. You've got, issues with pricing and rising commodity prices. So, these are all different things that you need to build into the assumptions. And again, it is an estimate, and you can only work with the data you have, and you don't know how long some of these scenarios are going to go on for. But that's where I say it's more of an art than a science. So,
Hey, Chris, I was doing years ago. I presented a seminar on prospective financials, which is similar to this. It's forecasts and projections. And I said in there, what is your primary driver? And Jose at the Union chapter, I don't know if you know him, he said on one of his projections, he uses inventory as a primary driver. And you deal, I know you deal with manufacturing a lot, and Chris, you deal with retail a lot. Have you ever used inventory as your primary driver?
No, I haven't.
I've never seen that.
I usually see it being sales.
Yeah.
And there might be some I'm trying to think what else, but usually I see sales because stuff is a percent of sales. But
right.
Yeah, he said inventory. I asked him for a copy of his projection just to be able to see it, redact it, but I never got a copy of it.
And then not only sales, but then you can drill down into other areas as well. So payroll may be driven off of sales, but certain aspects of payroll, like your benefits and taxes, you may want to take as a percentage of payroll. So there's different bases that you can use as drivers of your forecasts. It's not a one size fits all type of scenario. The other area that comes into the forecast outside of the variable type expenses, and I'm calling it fixed expenses here. There's not a lot of expenses that are really fixed, when you think about it. Rent may be one, at least for a certain period of time, but you have things that are a little bit more consistent, year to year, period to period, that aren't really driven off of sales. Things like utilities, real estate taxes, insurance. Those are a couple examples that I have here. While they may not be, exactly straight line fixed in nature, you can kind of predict them a little bit more outside of, you have an insurance claim or real estate, reassessment and things like that. You may want to just add, a certain percentage to each year based on, the history. Maybe real estate taxes typically rise, 5% a year. So you can build that into your forecast. Other things.
I'm surprised you didn't put depreciation up there unless you use some of the year's digits.
There you go.
I just like to throw that out anytime I can.
Yeah. And then, like I said before, using the information at your disposal, not operating in a vacuum. Industry information, outside, your peers in the industry that you can bounce ideas off of, market studies, those sorts of things are really important to forecasting. You can, next slide.
Yep.
And I just wanted to put together some examples here, just, some things that might get overlooked as you're doing your forecast. You look at a profit and loss statement, sometimes you're not thinking about the timing of certain things like accounts receivable. If your customers usually pay in 90 days, you can't expect that all your sales in January are going to be collected in January, right? Those cash receipts are going to be collected 90 days later. So making sure you're building those types of things in. If you have a history of bad debts, 1%, for example, building that into your cash forecasting as well. These things don't become that much of an issue if things are consistent over the course of a year, or you're doing a year to year and there is a lot of consistency. But if you're doing a shorter period of time, you really want to consider these factors. Things like inventory, again, we're just talking about inventory. If your sales are going to be going up, 10% per year, you think they're going up 10%. You also want to take into account what the inventory is going to be doing. How do you keep the shelves stocked? And that also couples with purchasing, cost of goods sold, which I think I have as an assumption in the next slide. And then property and equipment, again, what type of expenditures you're going to have to do to reinvest in the business. Do you have a history of remodeling a store if you're in retail? Every several years, all things that you need to consider in your forecasting.
So, Chris, just to back on the inventory side of it, just to keep in mind that, with the prices and the, the cost and everything going up through what we're going through right now with the, price increases, make sure you update your models and go through and update for the pricing increases, because inventory, as we know, everything's just super expensive. All the prices are going up and everything.
Yep.
So keep that in mind when you're doing your modeling.
Exactly. Next slide.
Chris, are you going to mention a template in any way? Talk about it.
Not specifically. You brought up the fact that we have a template that we can provide, and then Dave's going to talk a little bit about some of the different technologies that are out there too, and using.
Okay, good. The template I'm talking about is for the preparation of the cash flows, but people should be using, if not a tool that Dave may reference later on, if you're using Excel, my strong recommendation is create an assumptions tab and build off of there, because just what Dave said, I don't know how many times you guys have been involved in forecasting, and we just need a forecast quick. So you throw one together real fast with the balance sheet and income statement on cash flow on 3 different tabs. That's it. And then management looks at it and wants to make a ton of changes, and you're going through fumbling. If you create an assumptions tab and put everything in there and let everything build off of that, because as Dave said, this information is going to change. Right. If not just the economy itself, management's going to change its mind. Guarantee it.
Absolutely.
I do have just a general template I'm happy to share with people if they want it. But.
We kind of just talked about this and the debt I kind of mentioned before, so we can move on to the next slide.
Oh, you talked about the debt?
Yeah. Yep. And just some final kind of thoughts on the assumptions. Like I said, just obtaining information from wherever you can to help you. Marketing budgets are great. Where do you think sales are going to go? Getting an understanding of warehousing space and that sort of thing for purchasing, and information outside the organization as well. As Brad just mentioned, when you're pulling these things together, things may change, right? And you can also do different models, right? You want to go more aggressive if this is more for you want to drive sales. You want your salespeople to understand this, or there may be a little bit more conservative if it's something for a bank, or you're looking at things in that respect. You may want to go somewhere in the middle. So you'll have different forecasts depending on what the appetite is, and where you really where you want to drive the business. Mm-hmm. And these things should be updated pretty regularly. As things change, you should be updating your forecasts. Having an understanding of where the cash position is obviously huge for the business. Determines, if you have to borrow and that sort of thing. And, yep.
No, you were going to talk about the taxes.
Yeah, I think I mentioned it before, but we often overlook it. Now it's even more important for the business. You've got New Jersey business alternative income tax, which you have to take into consideration if you're a flow-through entity. C corps obviously pay at the corporate level, so it's a little bit easier to determine what the taxes are going to be. But when you have LLC and S corp owners who are taking distributions for taxes, that could be a huge drain on cash flow, at certain times of the year. So making sure you understand what your cash position is, so you have that cash availability to make those payments, is just really important.
Chris, you mentioned aggressive. Oh, wait, we have a question. Oh, no, please send me the templates. Okay. Shoot me an email, Gary, because in case I forget, I'll give my email address later on. Chris, you mentioned aggressive. Do you mention realistic? Can you talk about that at all later?
What's that?
Realistic.
Yeah, like I said, it depends on what you're trying to do with it. If it's something that you're trying to forecast to drive sales in the company, you may want to have more a reach goal, right? You may want to shoot a little higher, but you want to also have something that's more realistic, so you actually can understand where the cash is going to be at any given time. It's either a goal or the difference between a goal and what you think may actually happen.
Mm-hmm.
Yeah, my concern about people when they pull some forecasts together is just be realistic. There's
Yeah.
a difference between aggressive and realistic. And the example that I always give was I had a startup software company that was selling software at $15,000 a license. And I said, okay, now I'm the conservative accountant, but they were the true, like, opposite end of a salesperson. I said, well, how much do you think you sell? We'll probably sell 1,000 units. I said, okay, you're brand new. You haven't sold one yet. I said, but how many do you really think you're going to sell? Probably 1,000. I said, at 15,000 a pop. At first year, yeah, this is a hot item, hot item. Unfortunately, I was a little bit more accurate than them, and they sold one.
Oh my goodness.
Yeah,
That's the important thing about not operating in a vacuum. You want to bounce these things off of other people, and having these different assumptions that you can just kind of change by dropping in a different number, and kind of maybe using an average of those, over the range. That's sometimes a method that gets used also.
Right. Okay.
And then we're going to hand it over to Dave now.
So before Dave goes, I'm
polling
time. Let's hit a polling. I'm sorry. If you've used cash flow forecasting model, has it helped you better analyze cash flow needs and predict issues? Yes, it has been extremely helpful. No, it's just an exercise to go through as part of a monthly reporting package. That's an interesting consideration. Fortunately, that's still at 0. Still don't know what forecasting is. That's right. Oh, we're up to 6%. 5 to 6% said no. The problem that I see a lot of times, and I spent 9 months in private, so I'm not saying I know what industry's like, but one of the things that I remember is that somebody will ask for a report once just to see the information, and the person preparing thinks this is something that they really want to see every month, and really all they wanted to see it was once. And there was a problem is that some people prepare the cash flow forecast and they stop using it for the reason, and then somebody who's preparing is just like, I got to just do this, and nobody's looking at it. So needs to have a boost for its effectiveness. Mm-hmm. So 78% said yes, 13% said no, and 11% said, Chris, you're not doing well, because they still don't know what forecast is. Although on the Chris test, one asked and one answered so far. So you're passing. I'll give you that.
Here we go.
Nice.
All right. Dave.
Okay, yeah. So what I wanted to talk about really is kind of on the a cash flow dashboard. And like Brad, I spent like a year in private accounting as the controller of a publicly traded company, and we didn't have a daily, what we called them then was a flash report. So I had like 8 different cash accounts. At the end of the day, I'd get a report, I'd update it, we could download the information, and started doing that daily. I even actually had bank recs done daily. I don't know if that was necessary, but I wanted everything reconciled. I wanted to know what the cash position was. And one of the things to take a look at too, and projecting it out, I would take the opening cash, I'd project out what the collections were, what the daily payables were, so I knew what the cash was at the end of each day. So I think that's important. I think that was my main concern at the time, just going through and making sure what cash was, what bills were coming up. We had daily sweep accounts, so everything was sweeping to one account. So I wanted to make sure what each account was going through. And, it was easy to download everything from the banks online and bring it in and update that. And once we got in the system and habit of doing that, I think it worked well. So I was able to better manage cash that way. Looking to really just increase your cash flow. One of the main things I think is really doing the online payments. Taking a look at and see that, even on your invoices, put on the wire information on the bottom of your invoices. On your website, you can direct them to your website on your invoices to go there to make the payments. I think that's a great way to increase your payment, your collectability. I know even on our website, you can go there, you click on, you can make your payments. And some companies actually will give you a discount, if you make your payments online. One of the other things is lockbox services. So I've not seen many lockbox services now going on. I don't know if you've seen more, Brad. I really don't see that many anymore. It used to be a lot of lockboxes.
Yeah.
Some of historically, they still have them. They're still doing it, and they're kind of getting away from it, but not really too many, but it's another option. I mean, if you have it, you might want to consider going on to the online payments.
Yeah, the problem is, Dave, you and I talking about lock boxes is showing our age.
Yeah.
The presentation I did just before, the guy was talking about Pony Express. So yeah, I don't see lock boxes that much anymore.
I think one client has a lockbox, and that's it. So, as I mentioned too, offering discounts, if you pay quickly in certain terms. Another thing is really to get your invoicing done promptly. If you follow up on your aging, make sure if there's slow payments. If you have a payment schedule, make sure your customers are following the payment terms. If not, make sure that you call up, you follow up with them. If you have a collection group that can do that, I think take a look at that promptly. If not daily, look at it weekly. See when the payments are coming in, because you can map it out in your cash flow what your expected is, and then you can see what did not come in, and go back and follow up on that. So I think that would definitely help with your increasing your cash flows. The other side is the cash payments. Really take advantage of payment terms. If you get discounts, take advantage of it. Don't pay early. If it's, like I said, if it's due in 30 days, pay in 30 days. There's no reason to pay in 15 days unless you have an incentive. Use, again, the electronic transfer, make the payments on the day it's due. Don't pay it early. And you can actually set those up for the electronic transfers. I think would help with your cash flow. And then when you do your projecting on the cash flow, that money's going to be coming out. So that can all tie into your dashboard.
And Dave, one of the things I see people not doing as to managing payables is you've got to manage your relationships with the payables too. Is internal controls are like bills have to be paid in 30 days. So on the 20th day, no, if you have a relationship that you can either extend it a little bit or shorten it because you need to pay it earlier, manage the relationships, but nothing against PSE&G or these utility companies where there's no relationship. You put them on auto pay and you pay them the last minute that it has to be paid, because you're not going to be helping them or offend them if you pay them early or pay them at the very last minute. So
yeah, I agree. That I've also seen on the other side, and you might want to consider this, is some of the companies that have been paying in 30 days, they changed, and these are the larger Fortune 500 extended their policy to play within 45 days. So, I mean, it's something that you need to take a look at, something you might want to do, and also that takes on both sides of your cash flow dashboard to bring in those assumptions.
Now, my copy of the slide has a little star on the bottom that says, and pay your accountant within 5 days.
Well, that's what I said. If you go to our website, you got the little online payment. You can click right on it.
There you go. And now you're not talking. We're not addressing here today playing the float. That's a different story. And I know that there are companies and controllers out there that are proud of themselves and they figured out how to play the float. I knew a company that actually had their banks in Alaska, so it took the checks longer to clear. Yeah, well, Pony Express takes a long time to get up there, Chris. Okay.
Exactly. That's a good point. True. I mean, Brad, is treasury management. I mean, if you take a look at your cash flow on the treasury management side, some companies do have a treasury department. You're going to look at, based on your cash flow projections, you're going to be looking at your, 6, 12-month CDs, whatever you're going to put your money in. And that's more on the treasury side.
Yep.
I mean, but the companies and our clients probably don't have a treasury department. So it's something that, the CFO controllers could take a look at it based on their cash flow and see if you have excess cash. What do you want to put it into? The interest rates, hopefully, you're going to be coming up on that side of it, and you'll get better returns on your money. So that's really that's another story to talk about treasury management.
Yep.
This is just we wanted to put together just kind of a dashboard of what it would look like for on the KPIs, and something that each company would have to design basically for what you're doing now. I think that every company has what they might not call them KPIs, but you have some management tools that you're looking at. And if it's something that you have a link on your computer where you can pull up that data, you can pull it out of your general ledger and drop it in and come up with some results, I think would happen. And I think that's kind of a daily thing you want to have, these KPIs. I mean, this has been really just looking at, this just kind of shows alerts, gives you the cash on hand, cash flow margin, net variable cash flow, and it's something that's just kind of showing the trends, the target, and the results. So kind of something that you want to develop based on how you run your business now. So every company looks at different things. And then, okay, no, you go back. You can go to the next one. I mean, this is other one just showing a tool, more of a visual tool of the same information. And then some people like to see the graphs. You can see the kind of correlation between the operating cash flows and free cash flow. So you can see the correlation of what's going on and where you're going with your cash. So it's really just the modeling feature that pulling the information in and dropping it into a graph format. Which some people like the visual part of it. I mean, you could probably see trends. You could probably even, if you're going to project out, you can actually project it out and come up with what the trends are in the future. Would be something to consider as well.
So Dave, and it's personal preference. I agree with you completely. When you're talking with most management, as a preference style, what do you prefer to show? Graphs or pure numbers?
I like the graphs, Brad. Honestly, I think the graph, you get the numbers there, but I think the graphs little creatively create a picture. And then I think if you can show what is actually historic, as accountants, we work in a lot of historic data, but I think it's important to take a look at the assumptions going forward so you can see where the company's going. Historically, it's always good to see what happened, because that way you can trend and see what you need to change going forward. So I like the graphs. I'll be honest with you.
No, I mean, Rod Stewart said every picture tells a story, right? A picture's worth 1,000 words. So
I agree. And keep it simple. Keep it to all you need is a one-page KPI. You do not need, people looking at this just need a flash report. They need to see what's happening. They don't need a lot of the details. They need the overall picture to see what's going on. And then you can make decisions based on that. So I think that's important.
Yeah, because what I found is people get lost in the numbers. So I actually had a supermarket client, Chris, believe it or not, I had them. And they had a few stores, and we laid out each store in the columns, and it was a detailed P&L. And so you have all the stores, detailed P&L, but underneath each number was a change from the same time last year in italics below it. Can you imagine the amount of numbers we're looking at? And what I've found, and now that was historical, but even still projected, what I found is people get tied up in every little number and you never get anything done. Whereas if you looked at it on a graph, and yeah, it's all perspective, but if you looked at it in a picture, you could say, whoa, now this is really piquing my interest, rather than going number by number, line by line. So.
Yeah, I agree with, as accountants, we do get caught up in the details at that point. And I think you need to be able to take a step back and take a look at the global picture. Of course, you need to get the details in there to get to that picture. So I think it's hard to do both, the detail and then look at it globally. So I think if you have if you can get your accounting department to come up with some of these graphs, drop it in. And as the CFOs and owners, you can look at the charting of this. And if you need to drill down on, if there's something that comes up and you want to drill down on it, you can have the details.
Yeah, and I like seeing this, because you could see where the waves are going to be and say, okay, where it's flat, is it supposed to be flat? And I'm anticipating, you're telling me next July on here, or it said July of 20, so last year, but next July, it's going to be flat. Should it have been flat? Or do I expect it to be flat? Why do you think July is going to be flat? That's my half-year Christmas tree sales type of thing.
Right.
So somebody asked a question, Gary asked a question, is there a link between cash flow and required liquidity note? That's more, Chris, that's more towards you. Is there a link between the cash flows and the required liquidity note? So that's a nonprofit. Bridget knew nonprofit was going to ask a question.
So you're going to throw a nonprofit question.
Yeah.
You set me up.
Yes. Well, we want to see if you're going to pass here. Second question asked. Go ahead.
Is it? I'm going to go yes.
And yes, there's definitely is a correlation between the two, while they're not exactly tied as to the numbers, because actually the liquidity tells you what you have available for the next year or next period for the reporting period, whereas the statement of cash flow is historical. Liquidity is actually Gary's going to be telling you how you're going to be able to satisfy your liabilities. Statement of cash flow says that's historical. Now, the information can be linked and you don't want to have inconsistent. How can you satisfy that when your past cash flow is showing this? So I'm giving Chris a pass on that one.
Nice.
Yeah.
All right.
Okay. Okay, good. That was good. And I like this one right here. It kind of gives you an idea coming down with your operating cash flows, which kind of ties into what Chris was talking about in the statement of cash flows. And you can see from there down to the free cash flow, which represents the difference between your operating cash and free cash flow is really what you're paying on CapEx. So that's really your fixed asset acquisitions that you're coming up with. And you can see it went from 715. They have about $4,000 worth of fixed asset acquisitions. Free cash flow comes down to 711,000. And the net cash flow represents the difference between the free cash flow down through the net cash flow is any payments for debt financing. So you can see in this model here, the debt is paying down the interest on the debt for about $18,000. Coming up down to your net cash flow of 691,000. So it just gives you another picture. I like seeing the flow of this coming down to each one. It gives you an idea, and it helps you, project this out and also manage what you want to do on your CapEx acquisitions, and also what you're doing on your financing for, if there's additional debt, what you're paying down on it, interest payments. Here it shows dividends, if any, and it'll get you down to your net cash flows. So. And this should all tie in like we talked about. And then I like the idea of also this is historical is coming up with a projection of what your forecast is to be, and that'll help you with decisions on you with getting down to your free cash flow part in terms of what your financing is, and then managing what we talked about earlier is increasing your receivable collections and managing your payables is directly correlated to your operating cash flows.
And this is
a great chart.
This isn't something
I love the description, and then because everybody uses the words operating cash flow. Okay, I know what that is. Yeah. Free cash flow. Whoa, it's free? Money's free? Yeah. Really? How come net is after? And this kind of really describes it.
Yeah, and again, as we talked about, I like the visual part of it. You got the definitions up top, and then visually you could see where the money is going to and how this all plays out to come down to your net cash flow. So I thought it was a good visual graph.
Yeah, the only problem is I see my cash flow shrinking though now. Yeah. I like the numbers now instead. So now I figured it out, Dave. If you're predicting good, show nice pictures. If you're predicting bad, just throw a bunch of numbers up.
Exactly right. Stay away from the red.
There we go.
Yeah, I was going to say that this isn't something you have to come up with on your own. We didn't pull that together. There's a piece of software that can get used. There's tons of software out there. So there's a lot that goes into these types of things. So if you do it in Excel, it could be quite cumbersome. So looking at software, if you're going to be doing this on a consistent basis is something that can
This is software that we use. I think that Aurora in our office uses, right? One of our partners.
Yeah, exactly. Yeah, we're using it a lot in with her client advisory services department. These management reports, and I think people really like them. They seem to really like them.
Yeah.
Yeah, a lot of times we've done them in our we have Excel setup where we can drop in when we do our audits and reviews. We have analytics, and we do put it into graph format. And basically from on our side, from the accounting side, we use the Excel, but we do have a group that has the software that can drop this in and really put together some nice graphs.
Great. Okay.
So a little bit more on cash flow management. We talked earlier, Chris brought up also keeping the lines of communication open with vendors. If there's issues coming up with collections, obviously reach out to your customers if payments are going to be delayed. And so you know what's going on. If you find a trend that somebody's not paying, there could be other issues, put them on a payment plan. Come up with a way to collect that, offer some discounts, and try to get that collections sooner than later. We talked about the different factors going into the cash flow, really the AR, payables. One of the big things too is your payroll changes. In terms of many companies did get the PPP money. Keep track of your new hires coming in, which is going to affect your cash flow, whether you pay in semi-weekly, weekly, monthly, whatever your payments are. Make sure you drop that into your cash flow. You know what the number is. So you'll be able to manage that with your taxes as well, payroll taxes. Also monitor if you have overtime, monitor the overtime. If you know the overtime's coming, you have to factor that in. Again, we talked about seasonal businesses. If you know during that time you're going to have overtime, make sure you factor that into your projections.
Right.
One of the things too is sometimes overlooked is really just digging down into your expenses, kind of looking at what's jumping out, where you can kind of cut back expenses. It might be a matter of getting looking at different vendors, seeing what the pricing options are. So there's many different things that you can do on the expense side that you should consider, because that's all cash flow. Work with your internal accounting teams, work with your CPAs, advisors, make sure you go through, ask those questions. We try to bring up and look at analytically the expenses. We take a look at things, we challenge some of the expenses and try to, help you, save money and cut expenses where you can. One of the things too, depending on your business, if you have inventory, how much you should be holding. Inventory takes up a lot of money. Some of our clients, we have one client that imports frozen seafood. Their inventory is $25 million. The turn is, 3 times a year, and they just have to. They have they outsource the inventory, but they have to keep managing the inventory. They look at it. They do look at it on a weekly basis, and also considering, as customers pay you, borrowing more to acquire new inventory. Look at your line of credits. Asset-based lending is always available through your AR and inventory. The banks are more than happy to lend money. We just met with one of the banks yesterday. They're looking to, really, they have excess cash. They want to lend money. So if you have a line of credit, make sure you keep it. You might want to expand the line of credit. Take a look at your ABL. A lot of times it's based on your receivables and inventory at a percentage, usually 80%. They'll borrow up to, they'll lend up to 50%. So you just keep track of your ABL, what the demands are, what's included and not included. One of our clients has lending for asset-based lending, and also they insure the receivables. So something to consider. Look at new trends and demands that are coming around. And like I said, on the banking side, really, keep the relationships open with your bankers. I mean, if you have covenants, if there's going to be issues with the covenants, make sure the banker knows sooner than later. That way you can address it head on. Take a look at your projections, show the banker where you're going to be, how you're going to meet the covenants if it's going to be an issue. Renegotiate the covenants. I've seen that. It's not the bankers are willing to work with you. Yeah, like I said, expand the line of credit. If you don't have one, definitely look to get a line of credit. I had one client that had the line of credit. They never used it. They didn't want to pay at the time. They had to pay a fee, and they let the line expire. Sure enough, 3 years later, they needed a line of credit. And you know what the bank said? Sorry.
Yep.
And I told them, keep the line of credit open. There's no reason not to have it. I know times are good. Get the money now while you can.
It's a cost of doing business.
Right? There's no reason not to have it. If you don't need it, that's a good thing. I have clients that have a line of credit. They never borrow down on it, but they have the line of credit in place.
It's another form of insurance. That's all it is. Yep.
So.
All right.
Benefits.
Go ahead, because I got one more thing to do. Gotta let you finish this slide.
Okay, go. Okay. Really, the benefits, the cash flow forecasting that we talked about, and keeping track of it. You can make timely decisions, buy versus sell decisions, leasing versus buying. There's modeling out there depending how much money you have to put down on certain decisions. If you're doing M&A acquisitions, taking into account your cash flows, the borrowing needs for acquisitions, it's important. And make sure that any issues that come up, ability to pay large payroll expenses that are coming up. So, if it's the end of the year, bonuses are coming, make sure that's all included in your projections.
Okay. I'll put up the last poll because I know some people are getting a little anxious. Do you use dashboards which integrate cash flow forecasting as well as key performance indicators to report key areas to management ownership or assist you in your duties? So while that's up, I'll go to the next slide, and which says review of KPIs.
Yeah, KPIs. So KPIs, like we talked about, throughout the discussion here. I think it's a matter of, here's some examples, but really take a look at how you're running your business now. You do have KPIs that you do look at. I think it's a matter of putting it into a format where you have a dashboard and you can pull it up. If it's integrated with your general ledger, where key factors can be pulled into a spreadsheet, and that's something that you can pull up on a daily basis and take a look at. What are these key performance indicators that you want to see? So it's something that you should integrate what you're doing into a daily review dashboard.
Right.
And just final thoughts. We talked about, talking about COD payments, looking at discounts, quicker customer payments, might be beneficial to your cash flow. We talked about consider leasing equipment instead of buying it, where there might be a large down payment, keeping track of large purchases, mobile payment solutions. We talked about doing it online, wiring money in. On big contracts, look for deposits, look for large orders on long-term contracts, get the money up front, get a payment in advance. There's people, I think that's what we're doing these days. I think get the money up front and delay your payments to vendors where you can. You might want to extend terms, and you can talk to your vendors about that. And one other thing we talked about too, Chris and I were talking about, is really getting the credit cards. You can manage your cash flow. There's bonus rewards that you can get. You can track expenses. Typically, everything's allocated. And you can upload it right into your GL. You can put the expenses, code it, and include it there. So it's something to consider if you're not using that.
Great. So we don't have many other questions coming in. I appreciate the information you provided. It's a different type of topic, and I think it's very useful to management to see and understand how to get a basic understanding of forecasting cash flow, but see what KPIs are like, the different type of dashboards that are out there and how beneficial they are. And I think that people should start looking into this more. The old, I'm just going into Excel and dumping information into Excel. It's getting stale. I think people are not getting as much information from it. So I think that what you provided is very helpful. It gives you a different method, and you can always stick with the old tried and true of Excel or Lotus 1, 2, 3 if that works for you. I forgot what was before Lotus, but anyway.
Right, the old WYSIWYG.
Remember WYSIWYG? What you see is what you get.
Yeah.
Yep. Did you use that, Chris?
No, I know the abbreviation, but I get that.
So somebody did ask a question right before we were going to wrap up. Jerry asked, do you have any opinions about AR factoring to improve cash flow?
I mean, I've seen it in a few businesses. Usually the borrowing rates are extremely high. So sometimes it's a last resort, but if you're strapped for cash, it could be an issue. You have slow payers, and I've seen it in a nonprofit actually, that was dealing with a hospital system and historically slow payers. So, they factor their AR, but like I said, the cost of it sometimes is prohibitive.
Yeah, I would agree with Chris. I've seen clients with it. It is a costly way to finance the money. It's usually in situations where a company needs the cash, and they'll go to factoring. There's other methods you could use, but that's one of them.
And I agree with you guys. And we have a client that does factoring, and factoring absolutely serves a purpose. ABL absolutely serves a purpose. The alternative financing absolutely serves a purpose. What I see companies do not do. Ken, everybody knows Ken. He's said VisiCalc was before Lotus. Thank you, Ken. But the problem I see with factoring, and it's not the factoring, It's that the companies have got themselves into a position that they need to use factoring as an alternative source. And they're not then saying, okay, let's start planning, forecasting to figure out how we're going to get out of this and get back to traditional financing.
Mm-hmm.
And it's, is it then become a triage or just an indicator? I really wish that companies would then focus on, okay, what's the problem and how are we going to correct it?
Mm-hmm.
So, all right. So we're at 9:31. We're just right at the 1 hour mark. So I'll let you guys give a final comment before we close it out. Dave, do you have any final thoughts?
Yeah, no, I think if you don't have the flash, dashboard for your daily cash, I think it's important that you do set that up. That might be extreme to do the bank recs on a daily basis, but consider doing them on a weekly basis. Monitor the cash. I mean, that's, get it in quicker, collect the receivables, and manage your payables.
Great. Chris?
Cash is king, right? I mean, it's one of the most important things in the business. Just, make sure you're monitoring it. We talked a little bit about KPIs. The nice thing about the KPIs is that you can tailor them to your business. So, it's something you should really look into as far as monitoring operations.
Thank you very much. I was wondering if somebody's going to say cash is king. I saw the movie Dogma. Cash might be queen. Okay? So there. We'll go with that. Or it, in general. Mm-hmm. So I want to thank both of you for presenting. Dave, welcome to the platform. We look forward to having you on future sessions.
Yes,
I want to thank everybody for attending. You can view this session again if you want, or other sessions on our website.